to the U.S. trade action, with 25% tariffs against $155 billion.
America has dominated trade for decades, but this time, Canada is rewriting the rules. Supply chains are breaking, jobs are vanishing, and the consequences are bigger than anyone expected. What happens now? Will Washington back down, or will this escalate into an all-out economic war? Can Canada sustain its newfound power, or is it setting itself up for a crisis of its own? And most importantly, how will this impact you, your job, your cost of living, and the future of North America? The answers are shocking, so stay until the end. The miscalculated plan. Washington had done this before. For the longest time, the United States used its economic power to pressure trade partners into submission. If a country refused to play by its rules, tariffs and sanctions would follow, forcing them to concede. When policymakers in Washington announced sweeping trade restrictions on Canadian and Mexican goods, they expected the same outcome. Canadian leaders would protest, businesses would scramble, and eventually Canada would be forced to accept the terms laid out by the United States. It had worked in the past, but this time something was different. Instead of backing down, Canada retaliated in a way that no one in Washington had anticipated. Within days of the trade restrictions, the Canadian government unveiled a $155 billion counterstrike, targeting industries that were not only economically vital, but also politically sensitive for the United States. The message was clear. Canada was not going to be bullied. The United States had assumed that Canada was too dependent on American trade to fight back. But in reality, the Canadian economy had been preparing for this moment. Over the years, its leadership had strengthened economic ties with other global markets, reduced reliance on American imports, and built the resilience necessary to withstand a prolonged trade conflict. The retaliation was not a reaction. It was a calculated move. While American policymakers scrambled to understand the full extent of Canada's response, the first economic shockwaves were already hitting the United States. The trade war had only just begun, and yet industries were already feeling the pressure. And the first to crumble? American factories. The first casualty, United States factories shut down overnight. Trouble began when factory managers across the United States received urgent notifications. Orders were being canceled. Supply chains were unraveling. And businesses that had operated smoothly for years were suddenly brought to a standstill. Within days of Canada's retaliation, thousands of American factory workers were sent home, many of them without knowing when or if they would return. The Canadian countermeasures were precise. Instead of imposing broad tariffs on all American goods, they targeted sectors that were deeply dependent on Canadian raw materials. Industries where even the smallest disruption could halt production. The automotive sector was hit the hardest. The United States relied heavily on Canadian steel and aluminum, which were now subject to heavy trade restrictions. Without a steady supply, American car manufacturers were forced to slow down or stop production entirely. Assembly lines in Michigan, Ohio, and Indiana fell silent as companies struggled to find alternative sources for essential materials. But it was not just the automotive industry. Machinery, electronics, and industrial equipment manufacturers all depended on Canadian imports to keep their operations running. With supply chains cut off, factories that had once been the backbone of the American economy were now facing uncertainty. As the shutdown spread, economic analysts warned that the worst was yet to come. The loss of manufacturing jobs would have a ripple effect, impacting small businesses, local economies, and ultimately consumer confidence. But while Washington was still assessing the damage, Canada's next move sent another shockwave through the United States. This time, it wasn't factories that suffered. It was the tourism industry, the travel boycott, a multi-billion-dollar blow to the United States economy. Imagine losing millions of customers overnight. That is exactly what happened to the United States tourism industry when Canada issued an unprecedented call to action. Avoid travel to the United States. At first, American businesses dismissed the warning. They assumed that Canadian travelers would continue to visit as they always had, but they were wrong. Within a matter of days, airlines, hotels, and travel agencies across the United States saw a surge in cancellations. Trips that had been planned months in advance were suddenly being called off. Canadians, who made up a significant portion of international visitors, were choosing to stay home or travel to other countries instead. The financial impact was immediate. Florida, California, New York, and Texas, Some of the most visited states by Canadian tourists saw sharp declines in bookings. In Florida alone, Canadian travelers accounted for nearly 40% of all foreign visitors in previous years. Now, businesses that relied on their spending were in crisis mode. Resorts, theme parks, and luxury hotels felt the pressure first. But the impact did not stop there. Restaurants, shopping centers, and entertainment venues also saw a decline in revenue as fewer Canadian visitors crossed the border. According to industry estimates, even a 10% drop in Canadian travel could result in over $2 billion in lost revenue for the United States. And as the boycott continued, that number was expected to climb. For many American businesses, this was more than just an economic issue. It was a survival crisis. The tourism industry was already struggling with rising costs and post-pandemic recovery challenges. Now, with Canadian visitors disappearing, companies that had been on the edge of recovery were suddenly facing closures. But even as businesses began to panic, the true impact of the trade war was yet to be realized. Because while factories were closing and tourism revenue was plummeting, a new kind of battle was brewing, one that was political. Political chaos. United States governors turn against Washington. When businesses lose billions, politicians start to panic. Governors from major trade-dependent states began to speak out, questioning whether the administration's trade policies were causing more harm than good. Leaders in Michigan, New York, and Illinois, states that relied heavily on Canadian trade, demanded immediate action. Even members of the president's own party began to distance themselves from the economic fallout, while the administration had framed the tariffs as a necessary measure for national security. Lawmakers were now faced with a harsh reality. Businesses were closing, jobs were being lost, and public opinion was shifting. Corporate lobbyists, who had initially supported the administration's trade strategy, now turned against it. Major industries, automotive, agriculture, and retail, sent urgent warnings to Washington. If the tariffs continued, the economic damage would be irreversible. Public frustration grew as news outlets reported on factory closures and rising consumer prices. For many Americans, this trade war was no longer just a policy debate. It was something they felt in their daily lives. And as political tensions escalated, so did economic uncertainty. The trade war that had started as an attempt to pressure Canada had now spiraled into a crisis of its own. Factories were shutting down, businesses were failing, and local economies were suffering. But this was just the beginning, because while the United States was struggling to contain the damage, Canada was preparing for something even bigger, an economic shift that would change North America's balance of power for years to come. And the consequences? They were only just starting to unfold. U.S. farmers are desperate. Their biggest customer just disappeared. What happens when your biggest buyer suddenly stops buying? That is the question haunting farmers across the United States as they watch one of their largest export markets vanish overnight. For decades, Canada has been a major consumer of American agricultural goods, purchasing billions of dollars worth of wheat, pork, beef, dairy, and soybeans every year. That all changed the moment Canada announced its countermeasures against the trade war. With one decision, the United States' northern neighbor slammed the door on American agriculture, cutting off a critical source of revenue for farmers who had long relied on cross-border trade. The impact was immediate. Shipments were halted, contracts were canceled, warehouses filled up with products that had nowhere to go. Surplus crops began flooding domestic markets, sending prices into a downward spiral. Farmers who had already been struggling with rising costs found themselves unable to break even. The situation was even worse for livestock producers. Beef and pork exports had been a cornerstone of American trade with Canada, but now the supply chain was completely disrupted. Ranchers, faced with an oversupply of meat, were forced to sell at rock-bottom prices. Some were even left with no choice but to cull livestock, as the cost of feeding animals they could no longer sell became unsustainable. In rural towns across the Midwest and the South, frustration boiled over. Farmers took to social media, to the streets, and to Washington, demanding immediate government relief. The pressure mounted on lawmakers as agriculture groups warned that thousands of family farms could be wiped out if nothing was done. But while farmers were drowning in surplus and falling prices, American consumers were about to face the exact opposite crisis. Consumer prices skyrocket. Everyday Americans feel the pain. From groceries to gas, prices were rising, and fast. The moment Canada and the United States locked themselves in a trade war, the cost of everyday goods in American stores began to climb. It started gradually, minor price adjustments here and there. But as the weeks passed, the increases became impossible to ignore. Tariffs had made imported products significantly more expensive, and businesses had no choice but to pass those costs on to consumers. Items that had once been affordable were now inching out of reach. Grocery bills soared as food manufacturers scrambled to absorb higher costs for raw materials. Fresh produce, dairy products, and packaged goods all saw dramatic price hikes. And it was not just food. Electronics, home appliances, clothing, and even automobiles became noticeably more expensive. Retailers, particularly large chain stores, were caught in the middle. Companies like Walmart and Target warned that price increases were inevitable. They had relied heavily on Canadian imports for certain goods, and with those supply chains disrupted, they were now paying a premium to source products elsewhere. The same was true for small businesses, many of which faced the grim choice of either raising prices or absorbing losses they could not afford. At gas stations, the numbers on the pumps climbed higher. With economic uncertainty spreading, oil markets became volatile, driving up fuel costs. The effect rippled across industries, making transportation and shipping more expensive. Consumers were not just paying more for gas, they were paying more for anything that had to be transported, which in an interconnected economy meant almost everything. The hardest hit were lower-income families. Essentials that had once been manageable expenses now consumed a larger portion of household budgets. A simple grocery run that once cost a reasonable amount now required tough choices. What to buy, what to leave behind, and how to stretch every dollar further. As frustration grew, so did fear. But while everyday Americans were feeling the pinch at the checkout line, Wall Street was dealing with a completely different kind of disaster. Wall Street's nightmare. Investors start dumping stocks. Markets thrive on stability. This trade war was the exact opposite. From the moment the conflict escalated, investor confidence began to erode. At first, analysts believed the tensions would pass quickly, that cooler heads would prevail, and negotiations would resume. But as the crisis deepened and the economic damage became undeniable, panic set in. Stock markets across the United States took a nosedive. Companies with strong exposure to Canada were hit the hardest. Automotive giants, agricultural conglomerates, and retail chains all saw their stock values plummet. Investment firms began revising their forecasts, warning that a prolonged trade war could trigger a full-scale economic downturn. Major hedge funds and institutional investors responded swiftly, offloading shares in industries most at risk. Market volatility soared. The Dow Jones Industrial Average suffered its worst single-day decline in years. The bond market sent warning signals as well, with interest rates reflecting growing fears of an economic slowdown. Financial media outlets ran headlines, speculating about recession risks. Experts debated whether the economic damage could be contained, or whether this was just the beginning of a much larger collapse. In boardrooms across the country, corporate executives scrambled to adjust their strategies, bracing for a long and painful battle. The White House attempted to downplay the turmoil, insisting that the tariffs were necessary and that the market would adjust. But behind closed doors, policymakers were growing increasingly concerned. If the stock market continued to tumble, it could wipe out billions in wealth, shake consumer confidence even further, and make it nearly impossible for businesses to plan for the future. And just as the financial sector braced for impact, Canada was making moves to protect itself from the long-term fallout. Canada strengthens its economy, while the U.S. struggles. What if Canada did not need the United States anymore? As Washington scrambled to contain the economic damage, Canada was already looking ahead. Rather than waiting for a resolution, Canadian policymakers took swift action to insulate their economy from further disruption. They accelerated trade agreements with Europe, China, and Latin America, securing new partnerships that would reduce their dependence on American imports and exports. Businesses across Canada adapted quickly. Companies that had traditionally relied on American suppliers began shifting to domestic and international alternatives. New supply chains were formed, investments in local industries increased, and innovation was prioritized. The government provided incentives for manufacturers to ramp up production, ensuring that key goods previously sourced from the United States could be produced within Canada's borders or sourced from friendlier trading partners. The effects were clear. While the United States was experiencing economic turbulence, Canada's economy was showing signs of resilience. Though there were initial losses, the long-term benefits of trade diversification began to materialize. Canadian businesses were more self-sufficient. Consumers faced fewer disruptions. The economy, instead of crumbling, was evolving. Meanwhile, the United States was trapped in a spiral of escalating consequences. The trade war that was supposed to force Canada into submission was instead pushing America into deeper economic uncertainty. The industries that once relied on Canadian partnerships were now struggling to find alternatives. The businesses that once thrived on cross-border commerce were seeing declining profits. And this was not just an economic shift, it was a tectonic shift in power. The United States is no longer the trade king of North America. For decades, the United States controlled the economic landscape of North America. It dictated trade policies, set the rules, and ensured that Canada and Mexico remained dependent on its markets. That dominance is now slipping away. As the trade war escalated, Canada and Mexico took decisive action without Washington's involvement. No longer willing to be held hostage by unpredictable American tariffs, the two nations accelerated efforts to deepen their economic ties. Trade agreements once restricted by U.S. oversight suddenly moved forward. Industries that once relied on the U.S. as their primary trading partner found alternative supply chains, cutting Washington out of the equation entirely. Mexico, which had long been economically tethered to the United States, quickly shifted its strategy. It expanded its reliance on Canadian goods, reducing its need for American imports. With Canada investing in its own manufacturing and production capabilities, Mexico found new suppliers for raw materials that once flowed almost exclusively from U.S. factories. For the first time, the North American trade structure no longer revolved around Washington. Canada, meanwhile, saw this as an opportunity to ensure long-term economic independence. If American tariffs could be imposed overnight, forcing Canadian industries into economic uncertainty, then the only logical response was to remove that risk entirely. The country launched a massive initiative to diversify its trade, expanding agreements with the European Union and Asia. This meant fewer Canadian businesses were dependent on U.S. demand, and American companies, especially in manufacturing and agriculture, were rapidly losing their most reliable buyer. And as North America realigned itself, the rest of the world was watching closely. The global fallout. Could other countries follow Canada's lead? The trade war started as a conflict between two nations, but its impact was global. As Canada successfully diversified its trade partnerships and moved away from reliance on the United States, other countries began to reconsider their own economic relationships. For decades, Washington had used trade policies to maintain global influence. But now, nations around the world saw an opportunity to break free from that system. The European Union was among the first to respond. Germany and France accelerated trade talks with Canada and Mexico, giving both countries greater access to European markets. Negotiations that had been stalled for years suddenly gained momentum, as European leaders realized they could strengthen economic ties with North America without U.S. involvement. China, meanwhile, saw an opening to expand its influence in North America. It increased investments in Canadian infrastructure, energy, and technology, securing deals that once would have gone to American firms. For Canada, this was a direct path to reducing economic dependence on the United States. For China, it was an opportunity to gain a foothold in a region where Washington had previously dominated. Latin America also began shifting its trade priorities. Brazil, one of the world's largest agricultural producers, moved aggressively to replace American suppliers in Canada and Mexico. As the United States struggled with surplus crops and falling prices, Brazil capitalized on the moment, strengthening its position as a leading food exporter. The same was happening in Argentina, which saw Canadian buyers turning to its beef and grain markets instead of U.S. producers. Even India, a rising economic powerhouse, began reassessing its trade relationship with the United States. Canadian and Indian officials fast-tracked negotiations, opening up opportunities for increased cooperation. Canada's growing role as a global trade player meant that India had a new, stable partner, one that was not constrained by the unpredictable policies coming from Washington. The shift was undeniable. What began as a trade war between two nations had exposed a fundamental weakness in the U.S. economic strategy. If Canada could resist and build a stronger economy in the process, What was stopping other nations from doing the same? And while these nations were securing their futures inside the White House, the panic was growing. Will the United States surrender or keep fighting? The situation has reached a critical juncture, with manufacturing stalled, stock markets in chaos, and businesses calling for immediate action. The pressure on Washington's leadership is intensifying. The initial strategy to force Canada into submission has backfired. Rather than yielding to economic pressure, Canada has strengthened its trade alliances beyond the United States, diversified its economy, and highlighted the weaknesses in American supply chains. Now the question remains, will the United States choose to negotiate its way out of this crisis, or will it double down, risking even more severe economic repercussions? The first path is de-escalation. This would mean lifting the tariffs, negotiating new trade agreements, and attempting to rebuild trust between the two economies. Some lawmakers have already called for a reversal, arguing that the economic cost of the trade war has far outweighed any strategic benefit. Businesses have joined the fight, lobbying for an end to the restrictions that have cost them billions. Even some of the most vocal supporters of the tariffs are now reconsidering their stance as the economic pain spreads. If the United States chooses this path, it would mean a return to more stable trade relations, but at the cost of admitting defeat. It would also mean that Canada emerges from this conflict stronger, with new global trade alliances that reduce its dependence on the American economy. The second path is escalation. This would mean increasing tariffs, expanding restrictions, and attempting to retaliate further against Canada. Some hardliners in Washington believe that backing down would show weakness, arguing that the United States must assert dominance over its closest trade partner. If this path is chosen, it could mean even stricter trade policies, more aggressive economic measures, and possible government intervention in industries that have been affected by the crisis. However, this would come with enormous risks. Canada has already proven its ability to push back, and further escalation could push other nations to follow its lead, weakening American economic influence even more. If the conflict continues to escalate, the damage will not be limited to just these two countries. Global markets are already reacting to the uncertainty, and prolonged instability could lead to further economic slowdowns. Major American corporations, including manufacturers, technology firms, and agricultural producers, may begin shifting their operations to countries with more stable trade conditions. Supply chains will continue to suffer, leading to even higher prices for consumers. If the United States refuses to de-escalate, the consequences will extend far beyond its borders, reshaping international trade relationships for years to come. With each passing day, the pressure builds. Businesses are demanding answers. Investors are looking for signs of stability. The leadership in Washington faces a decision that will determine not just the future of American trade, but the balance of economic power in North America. Either way, the era of unquestioned dominance over Canada has come to an end. The next move will decide whether the United States can repair the damage or if it will cement its own decline. Can Canada maintain its advantage? Canada's response to the trade war was calculated, decisive, and most importantly, effective. By targeting key industries, strengthening its domestic economy, and expanding its global partnerships, it has managed to turn an economic attack into an opportunity for growth. Rather than being subdued, Canada found ways to pivot and strengthen its position on the world stage, setting an example of adaptability and resilience. The first concern is long-term stability. While the Canadian economy has proven resilient in the face of American tariffs, it is not immune to the effects of global economic uncertainty. As businesses adjust to new trade realities, supply chains must be permanently restructured, and alternative markets must be secured. If Canada does not continue to strengthen its new trade alliances, it could face setbacks as industries struggle to adapt to a world where the United States is no longer its primary trading partner. Economic isolation from its neighbor may, over time, force Canada to navigate challenges that require even more strategic global engagement. Another challenge is the domestic economy. While many Canadian industries have benefited from diversification, others have suffered due to reduced American demand. Some businesses have been forced to lay off workers or cut back on production as they shift their focus to new markets. In the short term, this adjustment period will be difficult. And if economic conditions worsen globally, Canada could find itself facing challenges of its own. The key to maintaining its advantage will be in how well it can sustain growth without relying on the American economy to stabilize it. Canada's ability to adapt quickly to a changing global economy will determine whether it remains a strong player or falls behind. Beyond economic factors, there is also the question of political resilience. And despite challenges, Canada has made one thing clear. It is no longer willing to be an economic subordinate to the United States. The trade war has forced it to accelerate its independence, proving that it can stand on its own in the global market. Canada's confidence in pursuing its own economic strategies is likely to inspire other nations in similar situations to rethink their dependence on a single dominant economic partner. So now the question is, what will the future look like with two giants, neighbors, going all out and escalating this war? What do you think? Let us know in the comments.